Hello friends, today we're going to be talking about what the term hard money means in real estate. Have you ever been in a situation yourself or heard of somebody who found a great deal on a piece of property, but they didn't have the means or the money to purchase the property? It's not a fun situation to be in, and one that could be avoided if that person understood what hard money means when it comes to real estate investing. So by the end of this video, I am going to help you understand what hard money loans mean in real estate and how they might benefit you in your real estate venture. In the video today, we're going to be covering three things. Number one, what are hard money loans? Two, how are they different from private money loans and who gives them? And three, I want to help you understand the terms and determine if hard money loans are right for you, whether you are receiving them, or even if you have the idea to be a hard money lender yourself. If you're ready, let's go. Now, sometimes in real estate, hard money loans can get a bad rap. And a lot of times it isn't even justified, it's just misunderstood. So what does hard money mean? Simply, it is money that could be borrowed outside of banking institutions. Most of the time they're called bridge loans or loans of last resort. And almost always they are secured with real estate property that have no liens attached to them. So they are different than a banking loan, but how? A lot of times with a bank loan, you need to come forth with capital. So you need to bring some capital to the table. A bank loan is usually a long-term loan with an interest rate attached to it where you pay over time and you're paying principal and interest. Whereas a hard money loan, it usually has points attached to it up front, meaning that if you were to borrow $100,000, just to get that loan, you're going to pay 2 to 4% in points up top. So instead of $100,000, you're anywhere between $102,000 to $104,000 with those points added onto the loan. And interest rates for a hard money loan are much higher than current interest rates are for long-term loans, anywhere between 10 to 18%. So why the big difference? Well, obviously, one, a bank is coming in and looking at you as a lender and borrowing to you based on your current situation, the money you make and your ability to repay the loan. A lot of times a hard money lender is coming in and borrowing you money based on the deal. There has to be enough equity in the deal for it to make sense for them. So what is a private money loan and how is that different than a hard money loan? A private money loan is usually coming from somebody you know, trust, and like, and they know, trust, and like you as well. And one interesting note in a variation between a private money loan and a hard money loan is usually a private money loan is a promissory note, not necessarily attached to a piece of real estate. Now, it could be attached to real estate, but a lot of times it's a promissory note in paying that loan back. So this gentleman was actually going to be a hard money lender. He was going to loan the money to somebody for a piece of property, and he thought it was a hard money loan. So he'd send it over to the borrower, and that borrower's attorney had fixed it up and sent it back to him. Now, when he started reading the fine print, he had realized that it wasn't a hard money loan, but more of a promissory note, which means it wasn't attached to the piece of property. And had he not read the fine print, he would have loaned that money as a promissory note, as a private money loan, versus a hard money loan, which at that time would have been secured by a piece of property. So being able to understand the difference between the two is really important because you're going to want to make sure that the loan you give, if you're a hard money lender, is secured with a piece of property. So who are the people that do hard money loans? Honestly, any seasoned loan officer should have somebody in their pocket who is a hard money lender. If they're worth their salt, typically they have somebody they can go to and say, listen, I've got this deal, it's secured with real estate, would you be willing to loan this money for this piece of property? Most seasoned loan officers will have somebody like that that they could turn to. And also, it's usually somebody who has cash that they're willing to deploy, and they want a better return on their money than just a standard 2%, 1%, 0.5% interest rate that sometimes is given in banks, even some that are a little bit higher, because they can earn anywhere between 10 to 18% on their money, and it's secured with real property. That's a pretty good deal, but you want to make sure that all the terms are set up in such a way that protects you as the lender and you as the borrower. And they really do look at it as an investment, right? Where it's secured with property, if you weren't able to make the payments on the loan, they have it secured with property that they could eventually foreclose on and get the proceeds of the loan that they gave you. Now, obviously there's risks involved. That's why interest rates are 10 to 18%, but being a hard money lender can be a great situation in real estate if you understand what you're doing. And just last thing, they typically don't underwrite you as a borrower like a bank would. Really, their interest is to make sure that there's equity in the deal, that they could loan the money, that if they had to foreclose on it, they could still get all of their money back and be in a good situation. While at the same time, if you are fulfilling your obligation as a borrower, they're making really good return on investment. And you as a borrower, the reason you would do something like this is because you understand that you've got an exit plan that's going to allow you as an investor to be able to turn and sell this property for much more than the interest you'd be paying over the course of a year on a hard money loan. Which brings me to one of the last segments of this. Is it really worth it? First off, if you are getting a hard money loan, it has to be a really good deal on the property that you're buying. There has to be enough meat on the bone for somebody to say, man, I am willing to put the money up for this piece of property, and you as a borrower willing to say, okay, I realize I'm borrowing $100,000 and over the course of the year, I am gonna pay back potentially $110,000 to $118,000. So meaning that if you bought the property for $100,000, you better have a plan to be able to sell it for much, much greater than $120,000, $130,000. And there's enough room there that you're gonna profit from the deal. Now let's talk briefly about being on the other side of it if you wanted to be a hard money lender. I've had a few people ask this question. I've done an episode before where I talked about hard money loans, but I've had people say, well, what does it look like if I wanna be a hard money lender? That sounds like a pretty good deal. How do I do that? I'm gonna jump into that right now. I want to show you what it looks like from the other side if you want to be that hard money lender and what to avoid, but also what numbers you need to understand in order to make sure that it makes sense for you. So first off, if you are going to be a hard money lender, you need to be in first position. You need to be the person, if the borrower defaults, you're able to take control of that property and foreclose on it if you need to. And secondly, and probably most important, you need to make sure that there's plenty of loan to value involved in the deal. And I'll go ahead and give you an example of this right now. Typically, we want loan to value to be better than 70%. I'm gonna give you a couple examples here. One where loan to value is better than 70% and one where it's worse, just to show you what will happen if you're the lender on this and you haven't done your due diligence. All right, so in these two different scenarios, we've got a purchase price on a piece of property that's $100,000 is what somebody's buying for it. Scenario two, somebody's paying $134,000 for the property. Now there's repairs that are involved. The first scenario, we got $28,000 in repairs. Second scenario, we have $50,000 in repairs. So total loan to you is $128K versus $184,000. And we'll say that after repair value, the ARV on both is $200,000. And so in these scenarios, let's look at the loan to value. So the difference in loan to value is 64% versus 92%. So let's see how that plays out. Now you might be thinking, okay, both of these loans that I've given are under the after repair value of what the market is on the actual piece of property. However, what happens if they stop making payments or you need to foreclose on the property? That's really where you need to do the due diligence to understand if this is a deal that you want to do. So let's jump into that. Now, anytime you look at a foreclosure, you've got to factor that whatever you're going to foreclose on the property, it's going to be 80% of the market value. Of the after repair value, it's going to be 80% of typical market price or the current appraisal of the property. So in both of these scenarios, the foreclosure value is going to be $160,000. The property is valued at $200,000, but 80% of that is $160,000. So when going through the foreclosure process, there are going to be some fees that are involved with this, right? And so I've just added them all up. It's $11,000 from admin, legal, taxes and insurance, and maintenance. There might be some fees that you don't see, but factor on anywhere between 10 to 15% of this number here. So looking at this, your proceeds after foreclosure on scenario number one is $149,000. Same thing on scenario number two, the proceeds after the foreclosure is $149,000. Now the total loan on scenario number one was for $128,000. And the total loan on scenario number two is $184,000. So let's look at total net gain or net loss. So in scenario number one, you still come out okay where you're a positive gain of $21,000 after going through the foreclosure process. So you were a hard money lender, you loaned money, they didn't pay, you had to foreclose on the property, and because your LTV was better than 70% or less than 70%, you were able to make that work and still come out on the positive. However, in scenario two, it might have looked like a good deal at first where you're like, the property's worth $200,000, I'm loaning $184,000. The property's going to go up in value. I'm still going to get my money. He's making payments. But if he stops making payments, he or she stops making payments, what happens at that point? You need to go through the foreclosure process. You sell at a discount. You have fees associated with that. And you come out in the negative minus $135,000. So that's why it's really important to understand LTV when you want to become a hard money lender. So hard money loans in real estate can really be your friend, whether you're a borrower or whether you're a lender. You just have to understand the scenario. And if you're a borrower, you have to make sure that the deal makes sense, that there's enough meat on the bone to really make sure that you can get all the proceeds out of that, plus be able to pay the loan back with a high interest rate. And if you are a lender in that scenario, you have to make sure that after you've lent the money, you've lent money for repairs and the purchase of the property, that is below a 70% loan to value, that there is enough equity there for you to be able to recoup your money if you have to go through the foreclosure process. Now, this has been my experience in hard money as a real estate investor, both as a lender and as a borrower, and I've done both. But I'd be interested in what you've seen, so please comment below, let me know what you think. And as always, I've got a free gift for you, aaronsfreetraining.com. Just click on the link below. It's actually a short-term rental calculator that you put the numbers in on a deal that you're analyzing, and it'll spit out to you whether it's a good deal or not. Anyway, thanks for stopping by and visiting. Have an awesome day.